In this session, I'm going to talk about the how the subprime mortgage credit is actually securitized. So, right from understanding the process and even going ahead with some of the frictions underlying this process, we would look at the key characteristics of the subprime mortgage market and even the credit rating process associated with this, and some kind of predatory lending and borrowing activities. So just to get a brief hold of the same, the first thing I would like to look at is the securitization process involved with respect to the subprime mortgages. Securitization process. Now, all it initiates is with the borrower. Let's say a home loan borrower is there, right? Someone who wants to purchase a house, but he requires funds to purchase it. So he approaches for a mortgage, probably a bank. He approaches a bank for a mortgage. Now, the bank will do its proper due diligence of the party as well as the property and various other aspects. The bank will be performing a proper due diligence, and it may come forward to sanction the loan. And generally in these cases, the residential property is generally taken as a collateral for all these transactions. The property is taken as a collateral here. Now, when I look at the profile of the borrower, generally I categorize them into three major aspects. One being a prime borrowers category, one is a subprime, and one is the RTA category, that is the typical name associated with it. So when I look at the prime borrowers, they have very good credit history, whereas the RTA borrowers, probably they also have a good credit history, but probably they might have applied for very high loan, very heavy loan, or probably for a very longer time period. So probably the kind of application they have put forward requires some stringent evaluation of the party. So that is where these parties get categorized as RTA category. And the third one is the subprime, which is where they don't have a good credit history itself. They don't have a good credit history. Now, the borrower could fall into any of these categories. And typically, in any securitization process, as we understand, the bank, all these loans will become the assets to the bank. Right? All these loans are assets to the bank. Now, what the bank or any lending institution it can do is a significant portion of them are sold because they are assets. They are sold to third parties, typically called as special purpose vehicles, and they get back the cash to run their day-to-day operations. So these properties which are actually liquid, they are collaterals and they are liquid, they are sold to a third party and cash is immediately injected, means they become more and more liquid. And here also, whichever the prime ones, generally the lending happens to government sponsored entities itself, and probably some of the RTA ones also go there, but at least a good proportion of the subprime ones, they also get sold probably to some private agencies. And this is the typical securitization process. So the subprime ones are sold to some party, and this constitutes a very significant amount because in 2005-6 time frame, because of the boom in the real estate market, we see that the majority of the loans given by almost all the heavy weighted banks, they fell into the subprime category itself, right? So this is the typical securitization process. That so from a bank's perspective, it has securitized itself completely because it has sold off its assets for a fee to a third party, right? So the next thing which I am going to look at here is the frictions that could be present in the subprime mortgage securitization process. Now, when I look at frictions, they occur because of two major problems. One being the moral hazard, basically purely because of information asymmetry. This is purely coming up because of information asymmetry. There are so many participants in the securitization process. So the information asymmetry between two groups of people, they can take a advantage of having more information compared to the other parties. So typically we are talking about whatever the action someone is taking, it adds to the disadvantage of the others. For example, we have something like okay, the lender, who is otherwise called as the loan originator, right? And the third party, or probably and the arranger, who will pool all the funds and try to create an investment product out of it. Now, between these two parties, the lender knows more about the quality of the loan. Who are the borrowers? What is their quality? How much has been given? What is their real worth? The lender understands the better picture of the borrowers because he has directly interacted with each of those borrowers. But when he is selling the loans to, let's say, this arranger might not be having that much of information which the lender is having about the borrowers. So that is information asymmetry. Now, because of that information asymmetry, if I see that the lender can take advantage in terms of the arrangement with the arranger, like he looks out for to sell all these assets for a higher value than what their real worth is. That is where the moral hazard is coming into picture. So that is one dimension where you see a big friction coming up, and the other dimension is again adverse selection, which is also because of information asymmetry itself. So probably a person having more and more information, he tries to act as if he tries to take an advantage of that, and though he knows that there is a negative effect on it, he tries to project it as a positive effect, and he is more and more negligent about taking the minimal care about it. So it's like a person, if he knows, let's say we think about the lender itself. If the lender is confident that he is able to sell off all his loans to a third party, if the lender is very much confident that he can sell all his loans to a special purpose vehicle, which is a third party, he does not even mind performing a proper due diligence. He will not even do a basic minimum due diligence, or he will try to accept as much of subprime risk as possible because he knows every loan can be sold off to a third party. So some basic minimum care also will not be taken, and because he knows there is a protection. That is a mechanism associated with the adverse selection. So whatever the frictions we observe in the typical securitization process could be grouped either under the moral hazard kind of a problem, wherein person wants to act at the disadvantage of the other, and the second one being an adverse selection. He keeps selecting those policies, or probably it may so happen that he may retain all the good borrowers and sell off all the subprime borrowers to the third party. So because of these two characteristics, we see huge frictions coming up across all the layers, right from, let's say I may talk about mortgager, who is the borrower, versus the originator, who is the lender. There is a friction because see, generally a mortgager is not a finance savvy person, right? He is more and more unsophisticated about finance itself. So it may so happen that this guy may lure this person into various products which this person is not aware of, and probably which this person cannot assess properly also. So that's the friction in the market. Similarly, I have just talked about the friction that can exist between originator versus the arranger, or there could be some kind of a fiction that can come up between the servicer, who is actually collecting the cash flows, and who is following up on any kind of loan pre-closures or some of these things, foreclosures, the servicer versus the mortgager borrower. There could be some kind of conflicts and frictions coming up, and so at every layer, probably asset manager, who is supposed to invest the funds, versus the investor wants his funds to be invested somewhere, but the asset manager will try to invest them where he thinks there is a material advantage out of it, and even it can go to the extent of some kind of friction existing between the investors and the credit rating agencies, even because to a large extent the credit rating agencies are being paid by the originator or the arranger. They are not compensated by the individual investor. So it might so happen, though there is one argument which says the rating agencies are actually selling their reputation by giving the credit rating. So if they give any kind of false rating, probably it's like their reputation is sold. But on the other side, investor always feels that there is some conflict of interest that can come up in the process. So in the entire securitization process, there are various conflict of interest, there are various frictions arising at various points in time, and the mortgager and every player has to be aware of that, and they have to act accordingly itself. So it can involve right from the borrower to originator to arranger to asset manager to the rating agencies. All these pairwise conflicts can very well occur. Primarily, the broad area of classification of all these frictions could come either from the dimension of moral hazard, or it could arise from the dimension of adverse selection. One of these two major areas come into picture, and it can so happen that the due diligence itself, because of all these frictions, the due diligence and due diligence may not happen properly, and the underwriting standards may become more and more loose. They lose their stringency, they become more and more liberal, and even the credit rating agencies may go into this falsification kind of a trap. So that is one thing we have to understand as a part of the typical securitization of subprime mortgages process. All right. Now, when do we consider a particular loan as a subprime loan? Generally, there are a few characteristics associated from a borrower's dimension. If I look at, right, the subprime loan is nothing but from a borrower's dimension itself. They either have a history of past default, or they are giving some kind of indications for future default. All these will be categorized under the subprime category. So either they have defaulted earlier, or some kind of judgment has resulted in either the foreclosure of the loan, or probably bankruptcy filing happening. All these things directly indicate that the historical default of the person, or probably when we look at the FICO scores, anything less than 660, or probably a debt service ratio, greater than 50%, or probably loan to value much greater than 95%. All these things get categorized as indicators of future default. So the borrower might very well be put under the subprime category. All these borrowers are very well categorized as subprime kind of a borrower. And generally, when it comes to the loans for subprime, we look at them as adjustable rate mortgages. So adjustable rate mortgages are nothing but they are not fixed interest, but they go on a variable or a floating kind of an interest loan. Generally, they work out like 2 by 28 or 3 by 27 kind of stuff, means 2 years of fixed rate, 28 years of floating, or 3 years of fixed and 27 years of floating kind of stuff. And floating could be anywhere based on the LIBOR rate. And what we observe in this process is because everything is floating, the borrower is absorbing the risk, right? Whereas in case of a regular fixed rate kind of loan, the lender is absorbing the risk, whereas in typical subprime mortgages, we see that the borrower will absorb the risk, because most of them will be floating kind of loans itself. So this is how we categorize a typical subprime borrower, and we see that some of these characteristics associated with the FICO scores, or debt service ratio, or loan to value ratio, they are not that favorable, they are not that attractive. That is the reason that particular borrower will be categorized into a subprime borrower, and that loan gets categorized as a subprime loan itself. So generally those hybrid arms are typically there as a part of these subprime borrowing, and the majority part of the risk is, especially the interest rate related risk, is retained by the borrower himself. Now, when it comes to the securitization process for the same, all these loans, they have to be pooled, right? All these loans which are issued by the bank, they have to be pooled in such a way, okay? Different pools are created. Probably these loans are grouped here, these loans here. There is a pooling of the securities that is happening in such a way that the investors who are investing in these pools, because these pools are anyhow created from these pools as a backup, securities are created and are sold to the investors. That's a typical securitization process. The pools are created in such a way that whatever the cash flows that come from the underlying loans, they are paid to the investors. Now, in this process, the addressing of the credit risk is done in such a way, okay, these pools are designed in such a way that this pool, let's say, it will not face any kind of losses. This pool, probably the next, this pool is having more losses. Mean, if some people here are defaulting or delaying in their loan payments, instead of affecting all the pools, probably this particular pool only will absorb all the loss. So probably this is called as your equity tranche or subordinated kind of a tranche, which is like a seniority structure is created. Whatever may be the default that can come up, that default is absorbed primarily by one of the tranches itself, whereas the senior tranche, which is having a heavy credit rating, highly positive credit rating, that will not stop paying to their investors. So the pools are created in such a way that there are some senior tranches whose payments to their investors are not delayed by any extent, and there are subordinated and equity. Generally, let's say if the worth of this assets pool is 105 million, various loans, the worth of the various loans, let's say, is 105 million, then probably these instruments, okay, this could be for 40 million, this could be for 30 million, and this could be for another 35, this something else could be there for 25 million, and probably this could be for the 10 million. Now this 10 million pool is the most risky, so it's as good as an equity tranche, whereas this 40 million worth is sold to investors and it possesses a very high credit rating also. So this will not, so even if a few investors, few borrowers have defaulted, these guys will not receive any payment during that period, but all these investors will receive. So this kind of a mechanism is called as the subordination process, where the process involves creating various tranches with different credit ratings and different priorities. So the losses are first absorbed by the equity tranche and then to the above. And even it may so happen that there could be an over collateralization also. Means probably if the assets are worth 105 million, the securities for which the capital is raised could be only for 100 million. So even if 5 million loss is there, that would be purely absorbed by this over collateralization itself. But if the loss is anywhere above 5 million, then it starts coming on to the equity tranche. So that is how the securitization process works. So typically while designing a securitized instrument, this kind of pooling process is kept in mind. this kind of tranche creation, subordination process is kept in mind. Then whenever, okay, these guys are paid a coupon and a principal. These guys are paid coupon and a principal. Now it is somehow made sure that whatever is the weighted average coupon they are receiving, the weighted average of the loan related interest payments and principal payments they are receiving. If I try to find out the coupon associated with that, weighted average of the coupon receipts from the various loans, it is ensured that that should be greater than the weighted average of the coupon that they are paying out. So the difference between these two, so if they are getting the loans at an interest rate of 6%, if they are receiving 6%, they'll try to make sure that, okay, this high credit rated borrowers, they are going to receive 4% itself, and probably these parties will going to receive 5.5%, and this are going to receive, let's say, 6.5%. Now weighted average wise, let's say if this is 6, this might become 5.4 or something. So this additional zero point 0.6 is what we call as the excess spread, and excess spread is also a kind of a buffer. It's also a kind of a protection that is designed. So the designing happens in such a way, that is what we call as consideration of the excess spread. It is designed in such a way that whatever is the weighted average of the cash inflows through the various interest and principal payments on the underlying loans is exceeding the weighted average of the cash outflows in terms of the payments on interest and principals to the various tranches. So that is one more aspect that is considered, and along with that we also will as a part of the securitization design process, there is a mechanism of shifting interest. What is this shifting interest? These probably it is designed in such a way that the senior investors, they get all the principal first, whereas the mezzanine and junior and subordinate kind of tranches, they receive only the interest up to a first few period, and only after that they get into the principal receipt. So some kind of shifting interest kind of mechanism also can be designed as a part of the securitization process. And at some point it may so happen that this over collateralization can very well be released once the interest and the principal payments are happening properly. There could be a release of this over collateralization based on the performance of the loan pool. So that's where we can think of adding some kind of performance triggers also to the process. So all these things and probably, as I discussed earlier, most of the underlying subprime mortgage loans, they go like okay, first 2 years is fixed, but after 28 years it is floating, or 3 by 27. In this case, what could happen is the first 2 years the risk is borne by the lender. The first 3 years the risk is borne by the lender. So to protect itself against this interest rate risk, the lender may get into an interest rate swap kind of an agreement or arrangement, where he tries to swap the fixed interest rate with the floating rate and protects himself against the interest rate risk. So these are some of the things that happen as a part of the securitization process. So a good understanding of the same is very much essential. All right. Now, the next aspect that we are going to look out here is the credit rating process that is associated with these subprime mortgage securitization. So when we are looking at the typical credit rating process, we know that it is it is a way to assess the futuristic losses. So there is an estimate of the future losses and the cash flows, whether they are sufficient to meet these future losses that are going to come up or not. So these things are estimated, and based on that any credit rating agency will assign a proper rating. And when it is seen that the rating is too low, and probably the originator is looking at improving the rating, probably some additional enhancements, either external or internal, have to come into picture. So, I mean, it is primarily a mechanism to talk about the unconditional view of the rating agency about a particular issue, about a particular loan issue or a bond issue that is typically getting made. So the prime thing that is being looked at is estimate the loss distribution, and also estimate the cash flows that can come up, and if the futuristic cash flows are sufficient to handle the losses that are going to come up, and if so, based on that an appropriate rating is assigned. But if the originator is not satisfied with the rating and he wants to improve the rating, there is always a mechanism in terms of providing additional enhancements for the process. But when we look at some complex securities, for a regular bonds and all, it's not that difficult to understand all these futuristic cash flows and all. But the more and more the instrument goes like an asset-backed security kind of stuff, the ratings become more and more complex. Compared to a traditional bond, the ratings of the asset-backed securities become more and more complex because of, I mean, it's more like a pool of funds. So there is some kind of a portfolio behavior associated between the various funds that are there, or various securities that are there as a part of the ABS. So there could be a correlation between the various assets that are there in the pool, and the economic forecasts, which may result in either foreclosures or prepayments kind of thing coming up. So when you have to assign a credit rating, especially to these asset-backed securities kind of stuff, especially subprime mortgages also fall into similar kind of categories. So the credit rating to those kind of entities become more and more challenging, because when I look at a typical bond, and when we look at the credit rating for that, it is more and more linked with the company's performance and all these aspects. But when I look at rating of an asset-backed security, it is purely a claim on a portfolio or a pool of loans that are there. So how well people pay is the determining factor, or so what to what extent the due diligence is performed in terms of the issuing of the loan. So there is something heavily different with respect to a corporate bond. So enough understanding of the credit rating process should happen, especially when the evaluation of these mortgage backed securities or asset backed securities are being looked at. And one more thing that is expected is, typically any credit rating that is given, it should ensure that this rating is given through the cycle. The reason being, see, the real estate as a market, it has a very booming phase as well as a falling phase. So it should not happen that when the market is booming, the rating improves, and when the market is falling, the rating falls down. That should not be the approach of the credit rating agencies. then the credibility of these credit rating agencies will get questioned. So it should be for the entire loan cycle. Whatever the rating that is getting received, it should be targeted towards the entire loan cycle, but not a better rating during the boom period and a worse rating during the real estate bust period. But of course, whatever are the basic minimum enhancements, see, credit enhancements, whatever are required, depending on how the market is changing, depending on how the underlying securities are changing, enhancements, the value of the various enhancements might change during a particular period. So they could have an impact on the real estate market. So, yeah, so those things can play a vital role in terms of either reducing the credit, right? Generally, what we see is if the markets are down, the credit opportunities will go down. So that will typically happen also, especially in the up markets. More and more credit opportunities will come up. More and more borrowings can come up, even for subprime kind of borrowers. We see that the market will start opening up if the economy is doing good, if the housing as a market is doing well. But on the other side, what has also need to be looked at is whatever the ratings that are given by the credit rating agencies, they have to target the overall through the cycle rather than focusing on only for the current period. At the point approach is always not advised for these mortgage backed securities. It's always better to go with through the cycle approach itself. And what we typically see is after the meltdown, what we are seeing is the credit rating agencies, they are monitoring approximately, what we have as an information is they are monitoring approximately 10,000 mortgage pools. So monitoring each and every pool on a monthly basis becomes very, very difficult, right? So, but it is becoming more and more necessary. So today it is becoming more and more necessary to review each and every individual pool. So if there are some kind of metrics, is that will simplify the entire process. So what for that we are talking about two important or probably one important metrics, which is called as the loss coverage ratio. So the coverage. So whatever is credit enhancement that is present currently divided by the unrealized loss estimate, means what loss can very much occur, what is the quantum of loss that can occur over the next period, and what is the worth of the credit enhancement that is currently available. So the credit enhancement could very much, it could be in any form. Probably excess spread is also a form of a credit enhancement only. So to what extent is this credit excess spread or credit enhancement worth, if at all that enhancement metric is violated, or whatever is the target for those LCR, if it is violated, then the rating agency has to do a thorough review of the process, and if required, work out again on the credit rating process, right? And the final aspect that I want to look at in this context is the difference between a predatory Nowadays, this has become more and more of an important term to understand predatory lending versus predatory borrowing. So, when there is a predatory lending, the borrower becomes worse off. Right? Basically, we know that all lenders come together like a collusive agreement, and it becomes it acts more and more at the disadvantage of the borrower itself. So the borrowers, from a borrower's standpoint, after the undertaking of the loan is done, the borrower's welfare is getting more and more worse off. So the terms and conditions are not favoring the borrower at all, especially when it is worked out that the initial interest rates are very high. So what could very well happen is whatever is the EMI that the person is paying, it may so happen that even after paying for a few periods, the principal did not come down anywhere by any amount, and probably after the loan has been taken, the interest rates have fallen, but the equity levels are so high that he is not able to refinance that loan, because if he has to close off this loan and get it refinanced at a lesser value, probably he is entering into a huge loss. So the borrow, it is becoming very difficult in terms of refinancing, closing down the existing loans, or probably if there are some prepayment penalties that are kept at a very extremely high level. So the borrower is becoming more and more worse off after taking the loan compared to before taking the loan itself. So that is what is one scenario which is calling up the predatory lending process. But on the other side, I can look at a predatory borrowing process where the borrower himself is misrepresenting his financial conditions, misrepresenting his financial condition to get a loan. Otherwise, he would not be eligible to get the loan. Or probably what would have created him as a subprime borrower, he is trying to hide a few things with the lender to promote himself as a prime borrower. So, especially when the housing, when the real estate prices are typically mounting up, so as the prices are going up, the borrower might feel that he is, if the prices are still up in the next few months or years, he cannot even afford the house. So he can falsify the lender with a lot of false information, misrepresentation, some kind of a fraud, and try to get a loan for himself. So that is what going as a part of a predatory borrowing process. So the typical subprime mortgage securitization process, to understand that all these aspects need to be very clearly understood. If you have any further questions regarding the same, you can get back to me by giving me a call on the number provided below, or send in an email at vamsidhar@facegurus.com. Thanks a lot for listening to this session. Thank you very much.